Hello, this is Eamon Verdone, a member of Savant's investment research team, here with a review of the markets during the fourth quarter of 2015. The fourth quarter was good to most portfolios as U.S., international, and emerging market stocks rose in addition to global real estate and international bonds. However, U.S. bonds kept investor sentiment in check with a slightly negative quarter. The labor market continues to improve as 292,000 jobs were created in December. This helped the unemployment rate drop to 5.0%, which is considered full employment. Inflation continues to be low at 0.4%, but improved enough to allow the Federal Reserve to increase interest rates. On the economic growth front, U.S. GDP slowed a bit to an annualized 2.0% growth rate, which is what some analysts consider the new normal. Looking at this chart, you can see stocks ran off to a hot start this quarter before becoming range-bound. In October, China announced the ending of their one-child policy after 35 years. In early November, the jobs data release showed a 5.0% U.S. unemployment rate. In December, the Fed raised interest rates up to 0.25%, marking the first rate raise in almost a decade. U.S. large stocks bounced back with a strong final quarter, with the S&P 500 leading the way. Small stocks also gained ground this quarter, but at a slower pace. This widened the gap in performance between U.S. large and small stocks over the past year. Over the past 5 years, U.S. stocks have had high single-digit to double-digit performance as they continue to recover from the financial crisis in 2008. International developed markets all claimed modest gains in the fourth quarter of 2015. International small caps continued their terrific year with a return of almost 6% in the final quarter. For U.S. investors, international stock returns were suppressed by a strengthening U.S. dollar as the cost of exchanging currencies back to the dollar clipped performance. After a torrid start to the quarter, emerging markets were dragged down by falling commodity prices and finished the quarter with minimal returns. When isolated, emerging market small caps provided a slight positive return during the fourth quarter. Continued slowing economic growth in China and weaknesses among oil and other commodities created a rough year for emerging markets. Switching our focus to bonds, international bonds were the lone bright spot with a return of 0.6%. The expectation of the Fed raising rates, which came to fruition in December, led to lower prices among U.S. bonds during the fourth quarter. Global REITs were the strongest alternative, returning over 5% this quarter. Tumbling oil prices made consumers happier at the gas pump, but contributed to another difficult quarter for commodities. The new addition to Savant portfolios, managed futures, never got traction this quarter due to a lack of trends among most asset classes, leading to a slightly negative return. Next, let's look at the asset class returns together. The portfolios on this slide illustrate the hypothetical performance of different global stock and bond mixes of indices. As shown on the bottom left corner, the hypothetical investor with 100% stocks would have fared the best during this past quarter. Larger allocations of stocks have more risk and volatility in the short run, but have higher expected returns over time. The 5-year performance demonstrates this perfectly, with particularly strong performance for stocks relative to bonds. Despite flat years for many asset classes and an even more difficult year for others, diversification remains essential. There can be notable short-term volatility in markets, but evidence shows that as the time horizon lengthens, long-term investors that remain diversified are rewarded with a smoother ride to superior performance. In the beginning of the fourth quarter, the investment committee approved a recommendation to reconfigure the alternatives bucket in Savant portfolios. Global REITs will now comprise 25% of this bucket, while commodities and managed futures, a new asset class, will each make up 37.5% of the allocation. Managed futures focus on capturing the momentum factor seen in global markets. It does so by investing in futures contracts across stocks, bonds, commodities, and currencies worldwide. Managed futures' ability to take long or short positions allow it to profit whether markets are rising or falling. Let's take a look at 4 important concepts to understand why managed futures benefit diversified portfolios. By taking advantage of current trends in global markets, it has a low correlation with traditional asset classes. This gives managed futures the ability to create positive returns in both rising and falling markets, making it a diversifying source of return, which also lowers volatility. In fact, dating back to 1998, managed futures, which is represented by the orange bars, has generated positive returns in all but 2 years. Stocks, which are shown in blue, and bonds, shown in green, have markedly different annual returns. That wraps up the fourth quarter of 2015. Thanks for listening.